So in this video, we're going to continue what we discussed in the last video on the income statement for Wells Technical Institute. We're going to look at the statement of retained earnings and the balance sheet. So let's begin. So if you watched the first video, you recall we did the income statement. The next statement after that is the statement of retained earnings. Now, be aware that both the income statement and the statement of retained earnings have to be labeled for the period they cover. So the year ended December 31st, 2025, for example. And this would also be the year ended December 31st, 2025, where the balance sheet would only have the date, because the balance sheet is just a snapshot of, a moment in time. Usually they're all done together, but the balance sheet is not measuring activity over a period of time like the other statements are. Okay, so let's begin with the statement of retained earnings. So remember, retained earnings, is like a bucket that revenues go into and expenses and dividends go out of. We do not need to list the revenues and expenses again, since we already did that on the income statement. So all we need to do is carry the net income down and include the dividends. So the first thing we need to do is start with our beginning retained earnings. Okay, and we can get that from the adjusted trial balance. So we had retained earnings of $80,000 at the beginning of 2025. So our beginning retained earnings is 80,000. Then we're going to add the net income. Okay, remember, net income will increase retained earnings, right? So we add net income, and that's going to be 49,600. So we're getting that right from the income statement. Okay? And then we're going to subtract dividends. Now, you could do this in a couple of ways. If you want to show this as a negative on here, so you can use the auto sum, you can certainly do that. Or you could just put it in as a whole number, and then just remember you got to subtract. I think the easiest thing to do is just put it in as a minus. Okay. Now remember, on your income statement, you're not going to display ordinary expenses as minuses. Okay. If you go on in accounting, you'll learn about extraordinary revenues and expenses, where sometimes you have to do that. But these are ordinary expenses, and they would not be recorded as a negative. Okay. All right. Also, you need to make sure you put the word expense, okay, after each item. So, for example, you wouldn't just put salaries, because there could be salaries payable or insurance or rent. You have to put expense. Okay. So going back down here, we have net income, which we got from here, and then the dividends, which we got from the adjusted trial balance of 50,000. So just looking at this quickly, dividends, if you recall, they are part of the net income that's shared with the stockholders. So they paid out more dividends than they had in net income, which they may want to look at that for the future. So their ending retained earnings will be a little less than they started with. Okay, so since we used the negative here, we can use the auto sum. And so they have, let's try that again. So we have 79,600 in ending retained earnings. Okay, so we're we're going to end 2025 with 79,600, and we'll begin 2026 with that. Okay, so when we do the balance sheet, we're not going to use the retained earnings we have here. We're going to use the retained earnings that we just calculated, because that's the new retained earnings. Okay? Now, there are many, many, many financial statement ratios like we did up here. There are a few on the statement of retained earnings, but we don't really need to worry about those right now. So let's move on to the balance sheet. Now, this balance sheet, this is the account form where we list the assets on the left, the liabilities and equity on the right. Now, a lot of companies will also do the report form, which they'll do it more in like one column. But the easiest way to learn it is to do the account form. So what I would recommend you do, okay, is just pull all of your assets off of the adjusted trial balance. Now, we do not need to include the prepaid rent, as that is a zero balance. I mean, you can. You don't need to. So we're going to copy these over here, and then we'll do the rest of them. Okay. So these are all of our assets, right? And so what we want to do, okay, is we want to pull over the numbers from the adjusted trial balance. So these are going to be the ending balances in our assets, liabilities, and equity on 12/31/25. They will carry over to 1/1/26. Okay, these will not. These will be closed. Okay, which will be the subject of another time. Okay. All right. So for cash, we can do the same thing we've done before. Go up and get our cash number. Okay. And we can adjust the font after. Accounts receivable. We can get our teaching supplies, our prepaid insurance, our professional library. Now, the accumulated depreciation, if you recall, is an offset to the asset, so that has to be listed as a negative. Okay, so we can do equals negative. Remember, we don't do debits and credits on financial statements, so that's going to be negative 17.2, right? And our equipment, we've got 80,000. And our accumulated depreciation, same thing, equals negative, and that was 28.2. Okay. All right. So those are our assets. Okay. So we can put these in Arial 12. So then we're going to add up our total assets, right? And we can use the AutoSum for this, right? So I got 123,500. Okay. So that means our liabilities and stockholders' equity has to equal this, right? Because the balance sheet has to balance. If it doesn't, we have an error somewhere. Okay. All right. So for liabilities, we have accounts payable, salaries payable, and unearned revenue. So let's copy those over. Now these all happen to be current liabilities. There are times you might have a long-term liability, okay, and that would not be included in your current ratio, which we'll talk about in a minute. Let's do our total. Total liabilities. And then for stockholders' equity, we have common stock and retained earnings. Right. And And then we're going to have our total stockholders' equity. You may have to abbreviate some of this stuff, which is fine. Actually, this might work. And then we're going to have our total liabilities in stockholders' equity. Right? So you may have to abbreviate this, which is fine. So remember, these have to balance. These have to be the same amount. And even if we don't have enough to fill the whole column, these always have to be on the bottom, because we want to make sure that we can easily see whether they balance or not. Okay, so let's do our font. Again, the fonts and all that stuff is not something you'd have to worry about on a test. Okay. All right. So our accounts payable, again, we can kind of go back to the adjusted trial balance. And that was $26,000. Salaries payable was $400, if I recall. And then unearned revenue was $7,500. Right? So our total liabilities are $33,900. Okay? And then our common stock was $10,000. And remember, our retained earnings we're going to take from our statement of retained earnings up here, right? Not the old one. Okay, we have the new one now of $79,600. So our total stockholders' equity is going to be $89,600. Now together, the $33,900 and the $89,600 need to equal our total assets of $123,500, right? Excuse me. And they do. So we can be pretty confident that we're good here. All right. So with our balance sheet in balance now, we can do some more ratios. Again, there's lots of these. We're just going to focus on the debt ratio and the current ratio. So the debt ratio basically analyzes how much of our assets are financed in debt. Remember, we've talked about this, right? There's only two ways you can finance assets, right? Pay now or pay later. So you either finance them with cash or with debt, okay? So we want to look at, okay, how many of what percentage of our assets are financed with debt? So we can take our total liabilities, right, and divide it by our total assets. And so that's going to give us the $33,900, right? And we're going to divide that by the $123,500. So it's going to be pretty small, okay? All right, so I got 27%. So that's considered to be a very good debt ratio. Now, this is something we would have to check against other years and the industry as a whole to see if we're good, but that's a pretty good debt ratio, right? Now, certain industries may have very high debt ratios, like a bank, right? Because deposits are considered to be liabilities. Or, a lot of retailers have a very high debt ratio because a lot of their assets are tied up in inventory. So, and often those are purchased on credit, right, or on account. So, to keep some other factors in mind, but this company said basically creditors have a claim on 27 cents out of every dollar in assets. So that's pretty good. Now the current ratio is focused on our short-term stuff, right? So remember we talked about current assets or assets that we expect to use up or turn over within a year. So if we take our current assets, we can just add them up over here. More detailed balance sheets will break out the totals on here. But basically all we have to do is do the auto sum and select our current assets, right? Remember, the library and the equipment, are long term. So they're usually not going to be current assets unless they're in their last year of useful life. Okay. So the current assets for this company is going to be 53.9. So in order for me to get the current ratio, I'm going to take my current assets and divide them by my current liabilities. So I have current assets of 53.9, okay, and I'm going to divide that now by my current liabilities. In this case, all of our liabilities are current. That's not normally the case. So if we had long-term liabilities, we would not include them in the current ratio, right? But in this case, we have all of them are current. So the current ratio is 1.59. Okay, so the current ratio would not be a percentage, because what this really means is 1.59 to 1. Okay, meaning that I have $1.59 in current assets for every dollar in current liabilities. So I do not have to sell off my long-term assets to pay short-term debt. So that's kind of the purpose of the current ratio. Okay. All right. So we did the income statement in another video. We did the statement of retained earnings in the balance sheet. So again, I'm going to post these videos and I'll give you an assignment due Monday. All right. Thank you for your attention to this